Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. On today's edition, we're going to be discussing the Swiss going to the polls to vote on limiting EU immigration. We're next for the franc. Switzerland is a beautiful country with magnificent scenery and a high standard of living. It has become extremely attractive for people from the EU to visit via the open borders policy and subsequently move and set up home in the country. The Swiss National Bank, or the SNB, sets monetary policies within the country of Switzerland. The Swiss franc, which is commonly referred to as Swissy or CHF, is the fifth most traded currency in terms of global liquidity, behind the United States dollar. It is considered to be a major currency. It is considered to be a safe haven currency because of the country's economic stability, low interest rates making it attractive to borrow in, and making the currency attractive as a hedge mechanism. The SNB prefers a weaker currency to make exportation more attractive. 65% of its export market is with the EU. This chart shows the US dollar CHF pair going back to July. The area marked at position A shows a high of 0.9465, followed by a bear trend which takes us down to a low of 0.9000. This is a major psychological area of support for the pair, and then we have a subsequent bull run to its current level of 0.9286. On Sunday the 27th of December, Swiss voters go to the polls to vote on limiting immigration from the EU, which has seen a sharp increase in the last 10 years of 30%. The vote, known as Ecopop, could see immigration from the EU capped at just 0.2% of the overall population, thus restricting migrants to around 16,000 per year and effectively closing the borders to the EU. It also calls for 10% of its overseas aid to be spent on family planning projects in developing countries. This is where things get complicated, because the Swiss has certain rights and trading privileges, including a free trade deal, and is based on the Swiss Open Borders Agreement it signed up to as part of the Preferential Trading Pact with the EU. 25% of its workforce comes from within the EU. The counter-argument is that if you lose them, you lose the high quality of life that everyone in Switzerland enjoys. A breach of this mechanism would throw the agreement into a long grass and potentially cause economic uncertainties with the trading partners, and could cause the levies being introduced by European Union, which in turn would have a negative impact on the Swiss economy. While this may somewhat be negated by a weakening of the franc, it will likely cause volatility in the markets, especially for the USD CHF and other CHF pairs. More worryingly, it could also cause volatility in the euro because it will look similar to the Brexit situation to a degree, whereby major countries within the bloc and those exterior trading partners are losing faith in the closely tied and constructive trading arrangements. If you enjoyed the video, then please like and subscribe, and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.